Welcome back to the channel, everybody. I am the Main Street Investor, and I want to start this video with saying thank you for stopping by after my bit of a hiatus. I want to let you know that the video is going to be a little bit different than my previous ones. I tried to come back with a little bit of a fresher look, trying to make these videos a little bit quicker so that we can get to more stocks, more of your stocks, as well as the ones that I want to review. So without further ado, let's just hop right into this and try to keep this as short and as informative as possible. Today's stock is going to be the Campbell's Company, ticker symbol CPB, and that is a packaged food producer in the United States with a current market cap of about $10 billion. And so just to get on the same page about the company we're talking about, Campbell's is obviously known for its Campbell's soup and its Campbell's chunky soup, but they own a variety of other brands that are very popular in the US, including V8, the vegetable juice company, Pace salsas, sauces like Rouse and Prego, which we'll actually cover in a second, as well as snack companies like Cape Cod and Kettle Chips, Goldfish, which almost everybody knows, Pepperidge Farms, the cookies, Snyder's, the pretzels, so on and so forth. So these are the brands that we are talking about when we are speaking about Campbell's, not just the soup. And so, like I said, we were going to talk a little bit about the sauces, most specifically Rouse, which was previously owned by a company called Sovos Brands that Campbell's had bought out and paid for in an all-cash deal at $23 per share in 2024. This represented a deal value of approximately $2.7 billion, which is important when we start looking at the numbers because we're going to see some relative deterioration around that time. More recently, Campbell's has had a tough go at meeting its expectations with a large drop on weak quarterly sales and a guidance cut on their full year outlook for 2025. This was in their most recent report. The company saw net sales drop 2% in fiscal year second quarter 2025, which led their shares to drop 8% over the past 12 months. So that is enough of that. I told you we are moving fast. So let's get into the numbers for the Campbell's Company and find out whether or not this is a decent stock to buy today. So with my new charts here, the way to read this is that each color represents a different part of the balance sheet. So in this case, the light blue is total revenues. The medium blue is EBITDA, or earnings before interest, tax, depreciation, and amortization. And the dark blue is levered free cash flow. Essentially, we're going further and further down the balance sheet with top of the line at total revenues and the very bottom of the line at the company's free cash flow. And what we can see just generally is that one, Campbell's operates on pretty thin margins. They're not great. We'll see that a little bit more in depth in the next page. But we've also seen a relative stagnation for the company's 5-year revenue at 4% growth over the last 5 years, only a 2% growth in the 5-year EBITDA, and a negative 4.31% free cash flow growth over that time. So since 2019, this company has been relatively struggling, especially once we get towards the bottom line of things. As I said, margins will be broken down a little bit more. In the light blue, we have gross margins, in the medium blue, operating margins, and in the dark blue, free cash flow margins. So again, working our way down the balance sheet further and further. So Campbell's operates with a 30% gross margin, a 13% operating margin, and a 7% free cash flow margin. But what is more important to take away from this graph is the relative deterioration over time. It started with 34% gross margins and is now sitting at 30%. Its free cash flow margin was at 10% in 2019 and is down to 7% now. So Campbell's is clearly going through some sort of issue, probably in part related to inflation and input inflation, but the company is struggling to pass on its costs to consumers. Total assets in light blue and total liabilities in the medium blue have mirrored each other relatively closely. So there's not too much I would worry about here other than the fact that their quick ratio is 0.33 and the current ratio is 0.78. Now, ideally, we would at least want the current ratio to be above 1, meaning the company has more current assets than it has current liabilities. But at the end of the day, these larger, more established companies can tend to have current ratios and quick ratios that look worse than 1 and find a way to survive. Interest coverage is a lot more interesting when it comes to figuring out can Campbell's survive and continue to pay its debts. And what we see again is a relatively large deterioration in the recent years. This is why I brought up Rouse earlier, because 2024 was the acquisition point of Rouse, and we can see that the company continues to have issues with its EBITDA coverage at 5.35 versus a high of 9.7 in 2022, which is almost cut in half, and a current free cash flow interest coverage of 2.26 versus a high in 2021 of 4.5. So what these numbers mean is that with the company's EBITDA, it can cover its interest payments by 5 times, and with its free cash flow, it can cover its interest payments by 2.26 times. So this isn't a position where Campbell's is struggling to meet its interest payments currently, but that deterioration over time is a little bit worrisome, especially considering a lot of the debt that Campbell's has is at a lower interest rate than they will be able to refinance should they need to refinance that debt in the coming few years. The company has done a relatively small level of buybacks, shrinking the outstanding shares in the company by 0.26% per year. So it's not nothing, but Campbell's really isn't a major buyback company. And then finally, taking a quick look at dividends, we can see that the company's current dividend coverage is 1.66, meaning it can cover its current dividend liabilities by 1.66 times with its free cash flow. So the dividend is in decent shape, but again, we see this relative drop in margin between the free cash flow here in the light blue and the dividend in the medium blue, with 2023 being especially close at a free cash flow of $1.92 per share versus a dividend per share of $1.48, leaving only about 50 cents of room. The other interesting thing to point out is that Campbell's 5-year dividend compound annual growth is only 1.4%. So it is growing over time, but not very quickly, and that's understandable considering the company has seen a lot of margin contraction at the same time as it's seen sales stay relatively flat. So taking a look at financial valuations, we can see that Campbell's typically trades around a price to sales of 1.55 times, and it's been pretty consistent over the last 5 years. But recently it has made a major fall, dropping to just a current price to sales of 1 times, which is a discount to the average of 35%, meaning you can expect a pretty solid rally if Campbell's was just to return to its average price to sales of 1.55. The same is not true for price to earnings, where the company's current PE is about 23 versus its long-term average of 17.25. So it's above the blue line here, meaning it is overvalued, and in this case, overvalued by about 33% to its long-term historical average. When moving from earnings to EBITDA, though, we do see a much better picture, again below the blue line, meaning at a discount to its 5-year average, with Campbell's current price to EBITDA sitting at about 6 versus its long-term average of 8, leading to a 27% discount to its average. Free cash flow again has a discount in that mid 20% at about 24% discounted, with a current price to free cash flow of 14 against its long-term average of 18.5. Price to book value, or the value of the company if it were to be liquidated today, is currently at 2.88 times, which represents a 32.5% discount versus its long-term average of 4.27, which is represented by this blue line. So again, anything below the blue line is a discount, anything above the blue line is a premium to its 5-year average. Now, looking at the company's enterprise value to EBITDA, which takes into effect the company's debt load, not just its market cap, we can see that the discount shrinks just a little bit to about 22% versus its long-term average, and it currently sits at 7.5 times EV to EBITDA versus its average of 9.5 times. Now, what's interesting is that every time we've seen this company get down to this 7.25 to 7.5 range in the last 5 years, it has staged a decent rally. Now, a rally in EV to EBITDA does not necessarily mean a rally in price, but it generally does. So just something to keep in mind. We're looking at the company sitting at the lower range of its 5-year averages. And enterprise value to free cash flow largely backs up that same assertion, sitting at about a 19% discount today, which is around as low as it gets. But I do also want to point out that in this case, the 5-year average of 22 is highly skewed by 2024's numbers, where the company was sitting at about 30 to even up almost to 35 times its EV to free cash flow number. So I do think this average, if we didn't have 2024's poor free cash flow numbers, it would be skewed lower to an average of, say, 19, maybe 20 times. So that discount does get a little bit smaller if we take that into account. But again, that discount is generally as low as it gets right now, currently sitting at around 17.72 versus long-term averages that really only get to about 18, 17.75, something like that. And just to switch things up before we move on from our 5-year average charts, we have the dividend yield. And so anything above the average blue line here, currently sitting at 3.19%, would be better than sitting below the line, because of course you want to get paid more money for holding onto this stock, right? That's how I think, at least. So the current dividend yield for Campbell's is 4.29%, which sits 35% above its 5-year average yield of 3.19%. And as we can see, Campbell's has never really gotten that high. I mean, in 2021, it peaked at 3.65%. In 2023, peaked at 3.75%. So we are seeing a significant departure from anything normal as far as dividend yield is concerned for Campbell's, which should, at least to most investors, at least make this company interesting. Taking a look at the 10-year drawdown chart, Campbell's is currently sitting in a drawdown of nearly 50% from its all-time high. And that all-time high was reached all the way back in 2016. So it has been a long time since Campbell's Soup has reached a new high. We are also nearing the maximum drawdown experienced by the company, sitting at about 50%, 51%. So Campbell's Soup, historically speaking, does not draw down more than 50%. And on this slide, we are looking at the company's earnings estimates. Each different color represents a different time period. So the light blue represents 6 months ago, what analysts were estimating. The medium blue represents 3 months ago, and the dark blue represents the most recent estimates. And as we move from left to right, we have this year's fiscal year earnings estimates, we have next year's, and then we have 2 years from now. So ideally what we'd want to see is all of the lines sloping higher, which we do, that's good. But the second thing that we prefer to see is that the darker colored lines are above the lighter colored lines. What does that mean? It means that analysts are getting more and more bullish on the company's prospects over time. So in this case, Campbell's Soup is getting more and more bearish as we move forward. The company's current 2025 fiscal year EPS estimate is $2.95. That is unchanged for 2026, and in 2027, the company is expected to earn $3.13 per share. Now on this chart, we're looking at the implied forward price to earnings ratio based on the most recent estimates. So we take the numbers from this dark blue line here currently, and then we plot that in PE form, or price to earnings form, over time at today's current price. Now the dashed line up on top represents the company's average forward PE. So Campbell's Soup typically trades at an average forward PE of 17.25. So in this case, the opposite would be true for what we want to see in this chart. We would want to see the dark blue line be below the average forward PE, which it is, so that's good. And we'd also want to see it sloping downward, which again, it is sloping downward, although not by much. So we can see that the current forward 2025 PE and 2026 PE is 11.69 times, which is well below the average of 17 times. And 2027's forward PE is as low as 11 times earnings estimates. Always be careful, recognize that these are earnings estimates. They are subject to change, as the last graph just showed, but it is pretty safe to say that Campbell's is trading at a very cheap price on forward earnings estimates. And now the final thing we're going to look at are what I call the X factors. There are 3 of them. The first is the 5-year expected earnings growth, and this is a consensus from all of the top analysts, and that is currently sitting at 4.79%. That's not great, especially if you compare it to Nvidia or just the S&P 500 overall, but for a company of its size and in the consumer staples business, 4.79% isn't that bad. Second is the PEGI ratio, which is the price to earnings of the company currently divided by the sum of its growth plus yield. Essentially, it's like a price to growth ratio, but it includes yield. It's a better way of analyzing, I think, the overall total return of a company. Anything below 1 is excellent. Anything from 1 to 2 is decent, depending on the situation and the company. Anything above 2, not necessarily great. So 2.51 times on the PEGI ratio suggests that Campbell's is overvalued relative to its ability to grow and pay you as an investor. But there's a third ratio, and that's what I call the FG ratio, and that is the enterprise value, again, which is its market cap plus the total debt outstanding, divided by the free cash flow that the company receives, so the EV to free cash flow number, similar to price to earnings, and then we divide that by the sum of growth plus yield. So similar to the PEGI ratio, but instead of price and earnings per share, we're looking at the total size of the company as in its enterprise value and the free cash flow that produces, and comparing it again to its growth and yield. And the reason I do this is because sometimes you get very different pictures. And in this case, Campbell's is much better valued on a free cash flow basis than it is on an earnings basis. FG ratio is similar to the PEGI ratio. Anything below 1 is excellent. 1 to 2 is pretty good depending on the company. and anything above 2 is, not great. So sitting at exactly 1 right now is pretty decent for Campbell's Soup, and suggests that on a free cash flow basis, which I do actually prefer over earnings, Campbell's Soup is a pretty solid deal on its long-term growth and yield potential. And so for the final quick recap, I just want to get, a general score system going. It's going to be a little bit discretionary how I score things. That's how it goes. It's my YouTube channel, so I get to choose how I score. But everything's out of 15. The first 3 categories will be at maximum score of 4, and then the last category a maximum score of 3 to get to that final 15. So what we can see is that as safety score, I gave Campbell's a 3. The reason I rated it a 3 is because this is a consumer staple company. They sell food. We all need food. It's a company that has a lot of name brand recognition, and it will be around for a very long time. The reason it doesn't get a 4 is because of its deteriorating margins, its deteriorating balance sheet. There are certain scenarios where this company will struggle for a large period of time due to the debt and its lower brand performance. So that's why it doesn't get a 4, in my opinion. That leads me to the quality score of a 2, which, again, these are name brand companies. Everybody knows Goldfish. Everybody knows Campbell's. Everybody knows Rouse or Pepperidge Farms, but they're not performing. They're not growing, at least. They're quite stagnant in their market space. So these are going to be products that people continue to buy. It's going to help Campbell's survive as a company, but they're not necessarily going to help Campbell's thrive, or at least not right now. For value, I give Campbell's a 4. Most of the charts showed that this company is trading at valuations that in the last 5 years, it really has never been at, or if it has, it hasn't stayed there for very long. So this is a very undervalued position to be in, at least relative to its own past. And finally, I give it an X factor score of 1. And that is because the FG ratio, or the free cash flow comparison to the company's growth and yield, was really solid at 1. And that's not something you generally see with these very safe, almost bond proxy type companies. With that said, on a price to earnings and growth basis, Campbell's was pretty richly valued at about 2.5. And its long-term growth expectations of 4 to 5% is certainly nothing spectacular. So like I said, that earns Campbell's a 10 out of 15. Certainly a passing score, but it's not an exciting stock. So what I would suggest is if you're interested in Campbell's as a relative bond proxy, this is a great income play right now for you to check out and do more research on. You're going to get a really solid dividend yield and one that's probably relatively safe over time. This is not a company that is ever going to outperform the S&P 500 for long periods of time. So if total returns is more what you're looking for and less cash flow, Campbell's is probably a stock that you can skip. So with all of that, thank you so much for watching this video. Please let me know what you think about the new format. And while you're at it, like the video, leave a comment telling me what you think about Campbell's, give the video a like, and if you do enjoy stuff like this, subscribe to my channel because there's plenty more of this sort of video to come. Thank you so much to all of you who made it to the end of the video, and I hope you have an amazing day.